Welcome back to the financial plan. Today we continue our discussion around investments in general, but we will be talking a little bit about some of the products that are available out there generically. And last time we did actually talk about unit trusts and as a collective investment scheme as a popular choice. So we won't be going over that again today, but just remember that when you buy a unit trust, you've got the selling price is higher than the buying price. So if you are going to be in and out of unit trust in a short term, you could end up losing money. So you really need to, if you've got a 6 month to a 1 year time horizon, you'd be better off with a conservative portfolio.
And remember though, if you are investing into equities, you want to be looking at at least a 5 year time horizon in order to get what we call a real return, which is your growth on your portfolio over inflation.
Correct. Yeah. Okay. Speaking about products, the old generation endowments were very expensive due to a number of cost factors, one of them being front-end loaded commission. So they you had investors there that were pulling their hair out where
Were you one of them, Jay?
Did you pull your hair out?
Oh, right. Where they would be contributing for years and years and years, and only to find that they're receiving their money back in return, which is basically a return below inflation. So the good news is though that those products are pretty much redundant, even though they can still be marketed. They will be done away with under the new legislation, which is called Retail Distribution Review (RDR), which is already coming into force. There are, however, some lump sum single premium new generation endowments that are on the market that are very much worth considering, because they're inexpensive and you get the opportunity of getting a tax-free haven after 5 years, where once it's matured you can take money out tax-free and use it as income and stuff like that. So those are quite attractive. So Aidan, tell us a little bit about also unit trust product in a way, but it's actually quite a niche product called the tax-free savings plan, which is now available in South Africa. How that works.
So tax-free savings plan was introduced by the government to incentivize people to save, essentially. So how it works is you can take up to a maximum of 36,000 Rand per year. You can pump it into your tax-free savings account up to a lifetime maximum of 500,000. Okay. So if you do the maths, it'll take you just under 14 years to fill it up. You do have access to these, however we do suggest you use them as a long-term savings plan, so you can really take advantage of, as we mentioned last week, the wonder of compound interest over time.
Okay, all right. So when you say tax incentives, obviously you're getting a better return than you would normally through a tax portfolio, and it's tax efficient at the end and stuff like that.
Yeah, and literally all of the growth on the funds that you put into that is 100% tax-free.
Okay, cool. Moving the focus a little bit, Jean-Luc, towards asset management. What is an asset manager then?
Okay, so Jay, an asset manager is an individual who works for a company that deals with investors. This individual has a team of other individuals in which they make decisions on where they're going to invest the client's money, being the investors, in the different funds that they have based on what the client's chosen. And obviously each fund has different sort of mandates in terms of what it's trying to achieve and what sector it's going to be invested in, things like that.
Okay. Now, within that, I think there are different styles, right? So
yes,
you've got the growth sort of approach style, and then value managers. What's the story there?
Okay, so there are a few different styles, but it doesn't necessarily need to lean specifically on one or the other. But in terms of, let's say, growth investing, what a company is going to be looking to achieve there in growth investing is they're going to be looking at reliable companies that are going to provide a consistent growth over a longer term, nice spread of risk. So maybe a bit of minerals, a bit of equity, things that they see to be consistent and going positive over a longer time frame. Whereas now, if you look at something more like value investing is when a company is going to be, or the asset managers are going to be looking at specific companies that they feel are undervalued based on, let's say, their price earnings ratio, Obviously a bit riskier in the short term, but over the longer term, with a solid asset manager, certain companies, do start taking off, and that's when a lot higher growth is achieved, but there's a lot more peaks and valleys in this type of investing, if that answers your question, Joe.
Yeah, so what you're saying is also, though, that you don't necessarily have to, if you're considering a portfolio, you don't have to go with one or the other. You could blend both. And
So this is now what we call multi-manager investing. So this is when one asset manager will choose a variety of asset managers, let's say 6 asset managers, for example, and you could have 2 value investing and 4 growth investing, or vice versa. And basically what this is going to allow you to do is you're not only going to be able to achieve a consistent positive growth of investing, let's say in the more growth style, which is now just like your blue chip companies that are now spread of risk, but then also you're not going to miss out on returns, on picking specific stocks or specific minerals, that suddenly take off based on being undervalued. Like for example, if you wanted to pick Tesla before it had taken off, or a mineral like platinum or something like that, if that also answers the question.
100%, thanks. So now we've spoken about what's known as actively managed funds, and then the alternative to that is what we call passive funds or index funds, tracker funds.
Yes, yeah.
Talk to us about those then.
So those are portfolios that basically copy or mimic a market index, such as S&P 500 or the JSE Top 40 or the MSCI, that sort of thing. It's all run by a computer algorithm, and it literally just tracks these markets as time goes on. These sort of passive investments tend to be very cost effective, very low cost, because they don't have someone that's an active manager like what Jean-Luc spoke about, actually physically doing the work. They're just sort of leaving it to the software to track them.
And the nice thing about those sort of algorithms is that they don't necessarily need to track a specific index. You can have a very specific mandate, for a fund that's looking to achieve certain goals in a certain sector. Like let's say if you wanted to invest specifically in US-based tech, there you could come across a fund that is invested solely in that sector, obviously with different weightings in different companies depending on the mandate of the fund, but then you could achieve specific growth in that sector, and it can still be high risk, but also an aggressive style fund with the lower costs.
Right. And once again, is it fair to say that you don't necessarily have to, when making a decision as to where to invest your money, go with actively managed funds, a single manager or a multiple manager or passive? You could actually blend the two, or blend the three for that matter. Not necessarily blending the three, but blending the two concepts, so to speak. Because if you go back in time, active passive managers will say that if you look at the past performance in general, there hasn't been a big difference between the two. And then the active managers will argue that they would have seen the dips in the markets coming and stuff like that as well. So perhaps having a blended approach can also work as far as that's concerned. Would you agree?
Yeah, correct.
Yeah. Okay, guys. Well, we trust that you've enjoyed our chat today. We're wrapping up our discussion about investments. Next time, in our next video, we'll talk about offshore investing, both rand-based and also dollar-based offshore investing. So we hope you've enjoyed the video, and we look forward to seeing you in the next one. And don't forget to like and subscribe. Thanks very much.
Cheers for
now.